Welcome back to the deep dive. Today we're tackling one of the trickiest and, frankly, most misunderstood areas of business finance.
Sure.
We're talking about the transportation deduction.
Right. But we're being really specific here.
Yes, forget planes and hotels. We're focusing just on using your vehicle for travel that is not away from home overnight.
And that distinction is, it's the bedrock of this entire deep dive. We're looking at the rules for daily trips, the ones within your working area.
So what's our mission here today?
It's basically twofold. First, we want to give you a really clear roadmap to figure out when a trip stops being a personal commute and starts being a business trip.
And second.
And second, we're going to dissect the two big methods for taking the deduction: standard mileage versus actual expenses.
Okay, so it all starts with figuring out when a trip even counts as work. And that means defining your territory, right? This idea of a tax home.
Exactly. Your tax home is everything. It's your main place of business, your post of duty. Doesn't really matter where your family lives.
So it's not always my house.
Not at all. And if you don't have a main place of business, then it's where you regularly live. Understanding that starting point is kind of the whole key to this first segment.
All right, let's jump in. Segment 1. Drawing that line between a business trip and just commuting. The basic rule, the one that trips everyone up, is that your daily drive from your house to your regular office is a personal commute. It's not deductible.
Right. It doesn't matter if it's 5 miles or 50.
Or even if you're on client calls the whole way.
No, it's all considered personal. The cost of getting yourself to work is on you.
Yeah.
But movement during the workday, that's a whole different story.
Okay, so what is deductible then?
Things like driving from one workplace to another, or, visiting clients, going to a business meeting that's not your usual spot. That's business transportation.
This is where it gets interesting because the sources lay out 3 big exceptions that can turn that commute into a deduction. Let's start with the temporary work location rule.
Okay, this one is powerful, but it's conditional. So if you already have a regular office, you can deduct the round trip from your home to a temporary work location.
And what's the definition of temporary?
It's a place you realistically expect to work for 1 year or less. And it actually does last for a year or less.
So say I start a project, I think it'll be 9 months. I can deduct that daily drive.
You can. But let's say 5 months in, the project gets extended. Now it looks like it's going to be 2 years.
Uh-oh.
From that exact date, your expectation changes. It's no longer temporary. Your trips after that day are just a regular commute again. Non-deductible.
Wow, that's a sharp cutoff. Okay, what's the second exception?
This is for people without a regular office. Think field workers, contractors. It's the no regular office rule.
How does that one work?
If you usually work in the metro area where you live, you can only deduct travel to a temporary work site that's outside that metro area.
So if I'm a contractor and all my jobs are within my city, my first stop of the day is?
Still a commute. Non-deductible. The job has to be truly outside your normal zone for that deduction to kick in.
Which brings us to the third one. The one that feels like the holy grail for entrepreneurs. The home office rule.
Oh, it is. If your home qualifies as your principal place of business,
Which means you do your main admin and management work there.
correct, then suddenly any transportation from your home to any other work location in the same business is deductible.
Any other location? It doesn't matter if it's temporary or permanent?
Nope, doesn't matter. It completely changes the game.
Okay, another scenario. What about people working 2 jobs in one day?
That's more straightforward. The trip from the first job to the second one is deductible.
But what if I go home for lunch in between?
There's a limit. If you make a personal stop, you can only deduct what it would have cost to go directly from job 1 to job 2. No claiming the cost of your scenic detour.
Got it. And before we move on, let's hit those non-deductible traps you see. Parking fees at my regular office.
Non-deductible. Because the whole trip is a personal commute, and so is the parking in the end of it.
And what about hauling tools? This one always confuses people. If I need a big truck for my gear, can I deduct the cost of driving it?
No, not the whole cost.
Well,
The IRS says the main point of the trip is still getting you to work.
so what can I deduct?
Only the additional cost. Like if you had to rent a special trailer just for the tools, just using a bigger gas-guzzling truck doesn't make the commute itself deductible.
That really makes qualifying for that home office rule seem even more valuable. All right, that's a great look at the boundaries. Let's shift gears into segment 2. Once a trip qualifies, how do you actually calculate the deduction?
You have 2 choices: the simplicity of the standard mileage rate, or SMR, or the detail of actual car expenses.
And what's the advice here?
If you can, calculate it both ways, at least in the first year. See which one gives you a better result.
Okay, let's start with the SMR. It's kind of the easy button.
It is. For 2024, the rate is 67 cents per mile for business use.
And that 67 cents is meant to cover.
Yeah,
What exactly?
pretty much everything. Gas, oil, insurance, repairs, depreciation, registration, you name it. If you take the SMR, you can't deduct those things separately.
But there are some add-ons you can still claim, right?
Yes, two big ones. Business-related parking fees and tolls, those are deductible on top of the mileage rate.
Now for the strategic part. The lock-in rules. If I own my car, how do I elect SMR?
This is the part that requires some planning. You must choose the SMR in the very first year the car is used for business.
The very first year.
If you do that, then in later years you can switch back and forth between SMR and actual expenses if you want.
Okay, let me challenge that. What if in year one, I own the car and choose actual expenses, and I take a huge Section 179 deduction up front? Can I switch to the nice, simple SMR in year two?
Absolutely not. That's the permanent lock-in. If you choose an accelerated depreciation method, which is basically anything other than straight line, you are stuck with actual expenses for the entire life of that car.
Wow, so that year one choice is binding forever. That's a huge deal.
It is. And for leased cars, it's even more strict.
How so?
If you lease a car and pick the SMR, you have to stick with it for the entire lease period. No switching allowed, period.
And some people just aren't allowed to use SMR at all, correct?
Right. Two main groups. First, anyone who operates a fleet.
And a fleet is defined as?
Using 5 or more cars at the same time. Concurrently.
Yeah.
If you have 4 cars, you just alternate using them, that's fine. But 5 cars on the road for your business at once, you have to use actual expenses for all of them.
And the second group?
Is what you just mentioned. Anyone who has already claimed one of those big upfront depreciation breaks, like Section 179 on that car, you're permanently disqualified from the SMR for that vehicle.
That aggressive write-off comes with a long-term commitment.
It does. Which leads us perfectly into segment 3, the deep dive into actual expenses and the beast that is depreciation.
Right. So actual expenses are pretty obvious: gas, insurance, repairs. But what about financing? I hear being an employee changes the interest deduction.
It absolutely does. If you're an employee, even if you use your car 100% for business, you cannot deduct any interest you pay on the car loan.
Zero.
Zero.
Yeah.
But if you're self-employed, you can deduct the business portion of your car loan interest on your Schedule C. It's a massive difference.
Okay, what about taxes, like personal property tax on the car?
Those are generally deductible. If you're self-employed, the business part goes on Schedule C. If you're an employee, you can take the personal portion as an itemized deduction on Schedule A, but it's subject to some other limits.
Now for the really complex part, depreciation. The sources mention MACRS Section 179 and a special depreciation allowance, but it all starts with the more than 50% use test.
That 50% test is the gatekeeper. To claim the really aggressive options like Section 179 where you expense a big chunk in year one, you have to prove your business use was more than 50% in that first year. If it wasn't, you're stuck with the slow and steady straight line method.
And straight line just means spreading the cost of the car evenly over its, 6-year life?
Exactly. But here's the other catch. Even if you use it 100% for business, there are depreciation limits. The government won't let you write off a whole luxury car in 1 year.
So there's a cap? What's the number for 2024?
For a passenger car, the total combined first-year deduction, that Section 179 special allowance, everything all rolled together, is capped at $20,400.
So even if I buy a $70,000 car for my business, the absolute most I can write off in that first year is $20,400.
That's right. And if your business use is, say, 70%, then your max deduction is 70% of that $20,400. It really tempers that immediate benefit.
It does. That must be why you hear so much about businesses buying heavy SUVs.
It is. That's the strategic insight. For vehicles over 6,000 pounds, that Section 179 limit jumps way up to $30,500 for 2024, and they aren't subject to those lower passenger car limits. It's a deliberate incentive in the code.
Okay, now let's talk about the nightmare scenario. What happens if I meet the 50% test in year one, I take my big deduction, and then in year two, my business use drops to, 40%?
That's when the recapture rule kicks in, and it's painful.
What happened?
2 things. First, you have to immediately switch to the slow, straight line method for all future depreciation.
Yeah.
Second, you have to calculate your excess depreciation.
Which is?
The difference between the big deduction you took and the smaller one you would have taken if you'd been on the straight line method for day one.
And that excess amount, don't tell me.
You have to add it back to your gross income for that year. You're effectively paying back the tax benefit you took early. It can be a sudden, very nasty tax bill.
That sounds complicated enough to scare anyone away from actual expenses. Is there any good news here? What if those caps, like the $20,400, mean I haven't fully depreciated my car after 6 years?
There's a rule for that, for what's called unrecovered basis. You can continue to take depreciation deductions, still subject to the annual limits, in later years until you've recovered the full business cost of the car.
So you eventually get the full deduction, it just might take longer.
Right. It's a safety net.
That's good to know. All right, for our last segment, let's hit a few important caveats, especially for any employees listening.
The biggest one, by far, is the employee deduction suspension. Under the current law, unreimbursed employee car expenses are basically not deductible.
So if I'm a W-2 salesperson, I drive my own car 10,000 miles a year for work, and my boss doesn't pay me for it, I get nothing.
Until at least 2026, for most employees. That's the unfortunate reality. There are a few very specific exceptions, like armed forces reservists or qualified performing artists, but for the vast majority, the deduction is gone for now.
And there's another trap about reimbursement, isn't there?
Yes. If your employer has a reimbursement plan, but you just don't bother to submit your mileage.
You can't then turn around and deduct it yourself.
Exactly. The IRS sees that as an expense you chose to eat, not one that was unreimbursed.
Let's talk about trade-ins. The rules on that have changed.
They have. It used to be a lot simpler. Now, a trade-in is treated as two separate events. You're selling your old car and you're buying a new one.
So how does that affect the basis of the new car for depreciation?
The starting point for your new car's depreciation is the adjusted basis of your old car plus any cash you paid. It means you really have to track the old car's depreciation history carefully.
And the final point, the one that underpins everything we've talked about today, from SMR to actual expenses.
Allocation.
Allocation.
It's all based on mileage. It's non-negotiable. If you drive 20,000 total miles in a year, but only 8,000 were for business, your business use is 40%.
So you can only claim 40% of everything. Gas, repairs, even that depreciation limit.
Everything. And if you can't prove the mileage with a good log, you can't take the deduction.
So to wrap up, the big decisions are, first, is my trip even a business trip or is it a commute? Thinking about those exceptions, especially the home office rule.
And second, once it qualifies, you have that huge choice. This simple SMR with its strict first-year rule, or the complex but potentially higher value actual expenses method.
And that actual expense method, it's a bet, isn't it? A bet on your ability to keep great records and maintain high business use for years.
It absolutely is. And that leaves us with, I think, a final provocative thought for you, especially if you're thinking about buying a vehicle soon.
Okay.
Knowing that taking an accelerated deduction like Section 179 in year one gives you a bigger immediate write-off, but it permanently locks you out of the simple SMR for that car.
Yeah.
How might that change your choice?
Yeah.
Even if actual expenses looks a few $1,000s better on paper in that first year.
That really is the strategic deep dive. Something to think about as you're logging those miles. We'll catch you next time.